Hey, how's it going, everybody? Welcome to Finance with Avery. In this video, I want to talk about CD, certificate of deposits, and saving accounts, interest rates, and APYs compared to the federal funds rate. You've maybe seen it in the news what Jerome Powell has been stating at the Federal Reserve meetings, with the rate hikes and then the possibility of rate cuts, inflation this, inflation that. So there is a lot that's been going on in the economy in the past couple of years associated with inflation. And there are a lot of things that it affects when it goes up and when it goes down, along with the federal funds rate. When they raise it and when they lower it, it also affects other things. The banks, for sure. Federal funds last raised the rate back in July to a 22-year high. Since then, they've kept it the same, and they've been watching the data. And Jerome Powell, the chairman of the Federal Reserve, he's been hinting now at the possibility of no more rate hikes, just kind of keeping this rate currently. I believe it's around 5.25. Let's see, I got a better chart right here. Yeah, 5.25 to 5.50, and just kind of letting it hang out. And then there's been a possibility, if you've seen in the news, you can see a lot of the headlines looking towards cuts in 2024, lowering borrowing costs in 2024. Because when you lower the federal funds rate, you're lowering the borrowing costs for, loans, with car loans and auto loans. It affects that, not necessarily like one for one, like it instantly affects it, but that's kind of like one of the effects of it, basically. So when they raise rates, the federal funds rate is raised, you see, mortgage rates increase and loans for autos increasing, variable interest rates increasing. Also, what increases are savings deposits rates. A lot of, especially online banks, fintech companies have been raising their rates drastically in the past couple of years here with the federal funds rate going up. And if you've been subscribed to my channel, I put out videos pretty much every month about the top APYs for CD accounts, certificate of deposit accounts, and savings accounts. And you see right here the rates, how they've been increasing it right here. Back in March 2022, the federal funds rate, 25 basis points, then 50 basis points. And then they got really aggressive, 75 basis points, 75 basis points. So you see the jump right here. We pretty much went flat zero. And I'm gonna show you some charts too, so you can see this compared to the CD rates and everything. We pretty much went from zero to that first rate hike, not the first rate hike in general, but since dealing with this current inflation situation, to 0.25%, all the way up to about 5.25 to 5.50%. And so you see right here, like on this chart with the federal funds rate, it's been higher before for sure, even not that long ago, 20 something years ago. You see it around 6.5%, lowered it down, then it went back up 5.25%. Pretty much where it's at now, back in, you see that you see back in 2006, 2007, and it stayed there for a while. So this could be something to look at. Is the Fed going to let it hang out here for a while? There's a pause that's going to happen. The pause doesn't seem like it's going to go on that long. And then the possibility of rate cuts. So what rate cuts will do is it will spur typically economic growth. So because Jerome Powell has been watching the inflation data, and I'm going to show you the inflation chart here too. The U.S. inflation rate was definitely rising. I'm going to go out a little bit longer here with the inflation. So 3-year chart right here. You see it down pretty much 1.4% or whatever. And so you see it rising, hitting pretty much a peak of around 9% back in June 2022. And you notice the Fed rate hikes started about right here when inflation just pretty much got all the way up here in March 2022. That's when you start seeing the Fed was starting to raise the rates. Back over to this chart I want to show you. So yes. And it was aggressive. It wasn't even a step. You see the way it's kind of stepped back here, 2016, 2017, 2018. And you see kind of how it stepped. Pretty aggressive back here, 2005, 2004, 2006. Same thing right here, aggressive in 2022. Every month, 75 basis points really made a jump. You see the 75 basis point jumps right there. And so now, when you see that inflation rate right now, as it pretty much peaked around that June 22nd, the Fed rate hikes pretty much were kind of working. And Jerome Powell was talking about, transitory inflation. He was kind of, catching a lot of headwinds and a lot of criticism for that, saying, it's just going to transition. Inflation is going to just kind of, it's transitory. No, it wasn't too transitory. However, the federal funds rate being that high, and the way economic growth, people were still spending. There's a lot of spending on, credit cards, a lot of debt is increasing as well, which is a whole nother problem I won't get into with this video and everything. But so inflation has been cooling though. It's definitely been cooling. You've seen it a little bit pick up, but it's been cooling right here for months. For the past couple of months, it has been cooling, and Jerome Powell's been watching that. So back in the last Federal Reserve meeting in November, he was a little bit more hawkish. And when I say hawkish, I mean he was a little bit more aggressive as far as like, you mean if you're kind of familiar with investing and stock market and everything like that, you maybe know what hawkish and dovish are. But Jerome Powell's a little more hawkish. So he was kind of like a little bit more like kind of aggressive, like, hey, this guy might have some more rate hikes in his pocket. You know, he's really, he doesn't care what the market's doing, he doesn't care what you think. He's going to keep raising this rate. He's going to be hawkish. You know, hawks are they're predators pretty much. So, you know, they're, you know, however, now he's sounding a little bit more dovish. You know, a dove. You know what doves are compared to a hawk. You know, which one is more gentle? Which one would you be quicker to approach? You know, so doves are a little bit more gentle. So he's sounding a little bit more like soft kind of. So I'm like, okay, you know, hey, maybe we'll lower rates. You know, keep it here. You know, we don't need to keep raising rates. So he sounded a little bit more dovish. Of course, the stock market loved that. S&P was going up. Dow went up 500 points or something the other day. Like, so yeah, the market is really loving it, especially when these rate cuts are in the news now. Yeah, that's getting priced in the market for sure. However, how it goes along with the CD accounts and the savings rates. This is what I want to show you here. So first, we're going to zoom out on the federal funds rate and also show you the history of CD rates in the same years. So you see the federal funds right here. Yes, definitely been higher than what it's been at currently. This is high for sure. We've been dealing with this, and we've done with this, you know, in the past. We've dealt with even higher in the past. Look at the 80s. So I want to show you, you see in the 1984, 1985, around 10, 11%. And it's even better than what we've had recently here going on. And so you see how that high is. So you see that high, and you see what the federal funds rate was doing then. And you see it's kind of starting to decline right here, 86, 87. Let's look and see what CD rates are doing here. 86, 87, still high for sure, because, you know, the federal funds rate was still high. However, it was declining. Okay, and then you see it start to peak up a little bit right here. 1989, you know, so let's see what happened with the federal funds rate in 1989. Oh, 1989, we start to peak up a little bit right here. Oh, okay, all right. Okay, seeing some similarities, something going on here. Okay, and so then we start to go down here, and, you know, 91, 92, average CD rate, 93 is going down. Let's see what's going on with the federal funds rate. Oh, 91, 92, 93. Okay, definitely lower than what it was. Then we start to go back up a little bit, 95, 96, 95, 96. Where do we go? We start to go upwards. Okay, all right, let's just fast forward a little bit. We won't go through every year. Let's look and see what happened, and let's see what's going on with the federal fund rate in 2002, 2003 or so. 2002, 2003, look, we're lower. And then, hold on, 2006, 2007, federal funds rate went up. Let's look at the CD accounts. 2006, 2007, 6 month, 12 month, 1 year, you know, 5-year average CD rates increased. So as history shows, CD, certificate of deposit rates, pretty much correlate with the federal funds rate. When it's increasing, on average, CD accounts are increasing their rates, their APYs, which is good for savers. When the federal funds rate is increasing, it's a good thing for savers as far as the yield being higher for CD accounts and savings accounts. Yes, it's typically raising sometimes because of inflation, so you're feeling, you know, some pain elsewhere. You know, the cost of living is increasing. However, the savings rates are increasing. And so as you see, when the federal funds rate starts to decline, that average starts to decline. You see this period right here where it's really just kind of staying stagnant right here in 2012, 2011, 2013. What else was stagnant at that time? The federal funds rate, 2011, 2013, and so on. And then we start to catch up to where we're at now. You know, 2020, let's look at that here. Let's catch up a little bit. 2020, 2021, okay. And then 2022, 2023, I've got this up over here on this chart because as you can see, this average right here on these CD accounts are really low and paltry. If you've been checking out my channel, you know that the CD rates I talk about are definitely not around this 1% or so. So like this is a national rate because you do have a lot of CDs that don't pay, you know, these 4, 5, 6% that I've been talking about on my channel. However, you know, there are national rates that bring this pretty much national average down. But what I want you to pay attention to mostly is the trajectory of the chart and the rates. So in these past year right here, that you see, past year and a half or so, with the federal funds rates increasing, what's been going on with the 6 month, 12 month, and savings account average rates right here? They've been increasing. And some banks are like, oh, I want to pay you an even higher rate because I want your money even more. So, you know, there's competition as well. It's not just because the federal funds rate is raising. Competition also causes some banks, financial institutions to pay a higher APY and a higher yield. So it's correlating with that, a federal funds rate, and it correlates with competition because the banks want your money because they use your money to make more money on top of. So it's kind of like a thank you for letting us have your money. Here's something, you know. We're going to pay you interest on this. However, on the background, we're going to make more than the interest we're paying on you for this. So, you know, so it's a win-win situation for both right there. However, Typically, as you see, when the federal funds rates starts to decrease or stay stagnant for a while, that somewhat happens pretty much in line with savings rates, CD accounts rates, saving account rates. In Fortune magazine article, higher rates have benefits. Like I was telling you, higher federal funds rates mean the APY on your savings account, your high yield savings accounts, or certificate of deposit accounts increases when the federal funds rate rises, making saving more attractive than spending. Good for savers, like I was saying. However, the opposite is true. When the Fed decreases the federal funds rate, APYs decline. Annual percentage yields decline typically. So that's what we got to get ready for. If you've been subscribed to my channel, checking out my videos, then you know how high and how nice these APYs have been for savings accounts. Like you see my playlist right here. I make videos on this. I was doing it pretty much every month, and I kind of started to do so many other kind of videos. Had to spread it out to every other month or so. But you can see how these rates have increased definitely. Like I'm just going to go to January 2023 real quick. So you see here in January, 3.75, 4%, 4.10%. Number one that month, 4.35%. Nice. January 2023. Okay, now let's just fast forward. Let's skip a few months. Let's go to July 2023. All right, 4.75. Number 10 at 4.75. Wow. Okay. 4.85, 4.95%. Number one that month, 5.05%. See the increase. Very nice. Okay, let's go to the most recent November 2023. Number 10 that month, 5.05%. Wow, that's that's kind of funny. And a few months ago, 2023, number one was 5.05%. Now here in November 2023, a few months later, number 10 is 5.05%. And you see the rates, 5.10, 5.15, 5.27. Number one, oh yeah, that was a bonus. So yeah, number one, 5.40%, and then 5.50% betterment with that certain bonus. And definitely check out the video if you want to know more about all this. I go in detail about, these APYs overall, give an overview of the company, the financial institution themselves. I give a calculation example of how much a certain amount of money would be with that APY, depending on how it's compounded, things like that. So yeah, check out the videos for sure if you have it. But yeah, you see the increase of the savings accounts rates in the past year even. So hopefully you've been subscribed to the channel. Hopefully you have a high yield savings account. You've been taking advantage of this, having a high, nice interest rate and an APY compound on your savings account, your emergency fund, or whatever kind of savings account you're using it for. Hopefully a good emergency fund, some extra savings, whatever. So yeah, who knows when the Fed is going to exactly start cutting rates? Not anytime super soon, I don't think. I feel like it's going to probably hold off for a few months at least. So you're going to have these high APYs still stick around for sure. And when they start cutting, it's not necessarily going to mean, hey, these are going to drop down to, 2%, for number one. I'm still going to be doing these videos every other month or so. So you're going to see a difference for sure. And so definitely pay attention and track, what's going on. So, because I'm going to be doing these top 10 lists for sure. However, it's probably going to be declining some. However, I'm still going to, talk about the top ones and everything, but it's something to pay attention to just know, like, kind of prepare for it. But although the savings rates, APYs may start going down some, when the Fed funds rate starts going down, you will hopefully, be winning on the side of your everyday spending and things, because inflation, that should also mean that inflation is cooling and going down. So you'll still have that. And I still want to provide, the information for these APYs and everything and high yields. So also with CD accounts, it's the same thing. I have a playlist on the top CD account rates ranked by APY. I've been doing that for a while. I do different ones on that. I do no penalty, 6 months, 1 year. And most recently, I've been doing just overall top 5 high yield CD accounts. No penalty accounts, the difference between them and the other CD accounts is that you can withdraw your money at any time. Typically, they want you to wait at least like a month or something until you can do it. Sometimes 2 weeks and things. I talk about that in some of my videos. But after that certain little lockup initial period, you can withdraw all your money and the interest you've gained without any kind of penalty. So with a regular CD account, that's not a no penalty account. If you withdraw your money before that term is over, that 6 months, that 12 months, whatever the term is, 9 months, whatever it is, if you withdraw your money before that, then you will be hit with some kind of penalty. And it kind of ranges, depends on what bank or financial institution you're dealing with. Could be, 3 months worth of interest, 6 months worth of interest, the whole amount, interest. It just kind of depends, but there is a penalty associated with it. So that's something to keep in mind. Now, no penalty CD accounts have had some nice rates as well. Definitely check out my videos on them. And I'll still plan on doing those kind of videos. However, the regular, we'll just say penalty CD accounts typically have higher yields than the no penalty accounts, because they're, holding your money, you're locking it up for a certain amount of time, but they're locking it up with that caveat of, hey, you shouldn't be taking this out early because you're going to get hit with a penalty. So most people are going to not get hit with that penalty. They're going to let that money be locked up for that 6 months, 9 months, 12 months, whatever it is. CD accounts are great if you got a lump sum of money and you're just like, hey, I don't really need it. Right now I want a fixed rate APY. No matter what's going on in the economy with the APYs, it's going to stick there and give me that rate every month. So that's something to think about. Maybe if you got a lump sum of money that you're not going to need or anything, you're not going to need anytime soon, lock it up at a certain rate over the next year, over the next 6 months, 9 months. So in case the rates do start to fall, you'll still have that high yield locked up. Now, if you need that money maybe sooner, you're not necessarily sure you want to lock it up that long, check out no penalty accounts because they've been nice as well. We'll just check out, let's see. So let's go back, no penalty, March 2023. Let's see, top 5. Number 5 right here, 3.75% for an 11-month CD at Synchrony. Yeah, you can see the other ones. Ally's got a 4%. CIT Bank, 11-month at 4.10%. Okay, so that's back in March 2023. September 2023. So a few months later, number 5 on that list is giving you 4.82%. And 4.90 CIT Bank, higher right there. And then number 1 is giving you 5.30% for 4 months. So yeah, different terms, of course, with these no penalty accounts, but 5.30%. So you see the increase over time with that. Now let's just check out CD accounts in general. We'll check out on 1 year. Number 5, Barclays, 4.25% for a 1 year. Synchrony at 4.30%. Number 1 that month, 4.75% at First Internet Bank for a 1 year. So nice, back in January 2023. So April 2023. A few months later, number 5 on the list, 5.02% for a 13-month CD. Marcus by Goldman had 5.05. Bread Savings 5.05. First Internet Bank right there is number 3 at 5.06% for 1 year. And then we have CFG Bank at a 5.20% APY for 1 year. So April 2023. And what's going on with the federal funds rate? They've been increasing. So they're increasing. They start to slow. They're getting ready to start to slow right here. You see the increases. May, they pause right there after that. May, April, June, pause. July, increase. So let's see what's going on here. And the CD and rates and the savings rates, they've been increasing along with the federal funds rate and just on their own because, like I stated, competition was one of the main reasons why these rates have been increasing as well. So they weren't just going in line with the rates. And just because you see that 5% or something like that, they're not matching the rate exactly. Some banks and financial institutions say they kind of try to match the rate of the federal funds rate for their APYs, but that's not necessarily like a rule or something like that. Let's go to the most recent video I've done here and for December 2023, top CD accounts ranked by APY. Number 5 at 5.65%, BMO Alto, 12-month CD account, 5.65%. You have a 5.66, 5. You see how close they are? 5.66, 5.67. They're just trying to eke out each other. Just, hey, my rate is higher than theirs. But even though it's like 0.01% or something. Then you got 5.75%. Number 1 this month right here, December 2023, 5.76% 6-month CD account at Total Direct Bank. So you see the increases. They've been nice. They've been like fighting each other, trying to have the highest APYs and also increasing it because of the federal funds rate has been doing what? Increasing. Here's the average CD rates right here, 2020 to 2023. And as I was showing you the videos, as it was increasing, you see it right here on the chart also steadily increasing. Now, like I showed you on my videos, compared to the national averages, you see 2.01%, 1.59% for 6 months, 1.99, 2.01% for 1 year. So that's why I say check out my videos because I'm talking to you about higher APYs, accounts with higher APYs and higher interest rates. So yeah, on average, you see the rise. The accounts I'm talking about are FDIC insured. They're legit and everything. However, they're going to give you those higher rates because that's what I'm looking for, even higher rates. Now, 1 point something percent, 1.65, 75% is definitely better than 0.0 something percent. But why settle for that right there where you can get 4 or 5 point something percent? So yeah, definitely check out my videos on that because the rates that you see on national averages are going to be lower than the averages I'm talking about on my videos for sure. The synopsis of this video, so when it's CD and savings accounts rates versus federal funds rates, the thing to take away from this is that they somewhat pretty much move in line. It's not necessarily 1 for 1 at the same exact time when the rates are increased. Your rates on your APY savings account CD rates increase, but there is a nice, pretty much smooth correlation between that. Somewhat loose link, not so loose link. Overall, the trajectory is pretty much linked. When the Fed rates increase, savings rates increase. When they kind of stall and stay stagnant, Saving rates somewhat stall as they stay. May have little hikes here and there for competition reasons, or maybe some banks or financial institutions playing kind of catch up with their, rates that they're giving out. And then when the federal funds rate starts to decrease and they start to do cuts, then you see, financial institutions and banks lowering the APYs they're offering for savings rates. So when the federal fund rate decreases, the cost of borrowing for banks decreases. So they don't need to pay you that much, APY. They're not as hungry for your money to use for loans for themselves, to make money on, because their cost to borrow decreases. So they can, borrow money and, pay less on that than what they're paying on the APYs, and then use the money they're borrowing to make money on. So you see the correlation there, right there. When the federal funds rate decreases, the cost of borrowing, not just for you, for customers with auto loans and mortgage and things like that decreases, it decreases for banks as well. So you have that correlation. So that is it right there. That's pretty much the synopsis. What do you got to think about now? So since it's been in the news, and since it's pretty much going around, it's been priced in the market for sure, the Fed possibly is done currently with raising rates. I thought they might increase the rate one more time, just kind of really put the nail on it with inflation. It's be kind of a little bit more aggressive one more time. But it seems like they're not. It seems like they're going to pause for a while and then possibly 3 rate cuts in 2024. So with that in mind, you got to start thinking about how you're going to handle your savings. Hopefully you've had the high yield savings all along. It's not too late. If you haven't had a high yield savings yet, definitely check out my video. I've even got, a video on, I think it's really neat, on 5 reasons to have a high yield savings account. So if you're on the fence and wondering, why should I even have this? We're great video, detailed, explained 5 reasons to have a high yield savings account. So it's not too late to have that high yield savings account. Not too late to take advantage of a high yield CD account either, for sure. Keep in mind that, because that is a way you can lock in a rate. Savings accounts rates, APYs, are variable. So they're subject to change at any moment, month to month, week to week, or whenever. They could just change just like that. CD account rates are fixed. So they're going to stay that same rate for however long term the CD is, whether it be 6 months, 9 months, or 1 year. So that's something to think about. With the federal fund rates cutting in 2024, that means we may start seeing, savings rates decreasing and CD rates decreasing. But if you're locked in a CD for a certain amount of time, no matter what's going on with that CD at that specific financial institution or anywhere, you're going to be locked in at that rate that you're getting for the term of that CD. So something to keep in mind for sure. For all my savers out there, keep that in mind. Keep checking out the channel. I'm going to keep putting out videos on the top 10, the top 5 CD account rates and savings accounts rates, ranked by APY and all that good stuff. Hope you all enjoyed the video. Take care.